Hello, Easy Equities community. It's always great to chat to you. For those of you I haven't met before, my name is Carel. And yeah, I've been a little bit jealous of my colleague Carly doing all the webinars and chatting. So it's my privilege today to chat you a little bit about an exciting new listing on the platform. And I'm joined by Keith McLachlan. Welcome, Keith, and thanks for taking the time to chat to the Easy Equities community.
Hi, Carl. Good to be here. I'm very, very excited to be part of this.
I'm a little bit intimidated because Keith is wearing a tie. He's got a fancy audio setup. So I'm going to do my best to keep up with you, Keith. I was also told by one of my colleagues that they made a lot of money following you when they were in university because you did some great writing on small caps. So I hope you're going to help them make some more money with this product and to tell them why it's
That's
useful to invest in it.
that's absolutely the plan.
Good. I had another colleague telling me you're very good looking. So now with all of that pressure, best we don't disappoint them. So let's kick off. Tell us a little bit about Element Investment. What is the company? Where do you fit in? What do you guys do?
Sure, sure. Thanks, Carl. First of all, Element Investment Managers was founded in 1998 as Freighter Asset Management by James Freighter and Anwar Naga, and launched the first unit trust in 2001. So if you look at it critically, we've been in asset management over 2 decades. The first Sharia fund was launched in 2006. So we've almost been 2 decades in the Sharia space. Um, but simplistically, what we do is we're a fund manager, and there are 7 unit trusts that we focus on. We've got a deep bench of over a century experience on our investment committee. We work through, look at, analyze, talk about, eat, sleep, breathe these portfolios, these investments, and focus on making the funds do the best and most appropriate returns as we can achieve. And obviously, we're talking about the Element Islamic Global Equity Fund here, which is one of those 7 funds that we manage.
Awesome. Great. Thank you very much. And when did this particular fund launch?
So the Element Islamic Global Equity Fund was launched in 2012. So it's got a little over a 10-year track record. Since inception, it's done about 12% CAGR per year. Over the last decade, it's done about 15%. And in fact, in the last year, it's up 18 odd percent. So we're performing well. It's done well. The rand does help, but global equity markets have obviously been kind.
And the fund size at the moment, roughly?
So we're looking at it's about the fact sheet's 181, but as of this morning, it was about 189. Element investment managers in the Sharia space across the 3 funds that we have managed just under 500 million. So this fund is a good chunk of that. It's really we very proud of how this fund's done, how it's performed, and we think it's operating in a really exciting space.
Cool. So you guys aren't fly by night at all, quite the opposite. You're super smart. This fund is not insubstantial. So those are all good things for investors to explore when they're considering whether to invest in it. But maybe talk to us a little bit about Sharia broadly. So is this only for a particular kind of investor? I mean, must you be very much in the Islamic faith? You know, is this open to anybody and everybody? What would you say in terms of which kind of investors could look at this product?
Sure, and a good question, Coral. Perhaps, and here I'm borrowing from another fund manager. Unfortunately, for the life of me, I can't remember what his name is. So I can't quote him. I can't source it correctly, but they referred to Sharia as 1,000-year-old ESG. Long before ESG turned around, Sharia and Sharia finance specifically focused on ethical investing. And I'll give you an example in the Sharia space. There are prohibited activities that one cannot invest in, known as haram. And haram activities include alcohol, businesses operating in alcohol, tobacco, arms and ammo, pornography. Oh, these things starting to sound very familiar. It's almost in the modern day we repackaged that and called that ESG. So on the first hand, Sharia sensitive investors, this is absolutely a fund for you. We've got a top notch, in our opinion, the best quality Sharia committee in South Africa, including an international scholar who makes sure that we color inside the lines here. Everything is done according to the book. So there's no Sharia risk in terms of this. But then in terms of the broader way to view this, is it's actually an ethically invested fund. You know, and unlike perhaps many other, I was wondering what the opposite of fly by night is. Is that walk by day? But the opposite of, but fly by night ESG funds, they've got it on the label, but when you dig into the underlying, there's a lot of like subjective decisions being made, and no one really checks up on them. Our These funds are audited from a Sharia perspective. There is a certificate saying since inception, these funds have done what we have said they have done. We have operated within those lines. So perhaps that is a way to position Sharia investing for those that aren't necessarily Sharia sensitive, but perhaps are ethical investors themselves.
Great, thanks. I think you've explained that really well, and you disclosed the makeup of that committee on the front fact sheet, so people can check that out. And so, simplistically, really, I mean, your smart asset managers are the ones that pick the stock, keep this going, and in addition to that, there's an additional overlay of this committee that ensures that you adhere to what you said you were going to do. So, I think that gives a lot of comfort to investors. Maybe you can talk to us a little bit about the top holdings or one or two that are in this fund. And again, all of this information you disclose on the fact sheet, and investors can look at it. But maybe just an example of one or two of the holdings in the fund.
Sure. So, simplistically, to understand how we run the fund, I just want to touch on our investment philosophy, which we
Right.
hold at an investment committee level. So, we are fundamental investors, and within that, because you're buying parts of businesses, what businesses do you want to own, and you want to understand those businesses. And we prefer holding good businesses over bad businesses. So, we are effectively a quality investor. We have a quality bias, but within that, when you overpay for a business, there's also risk. So we are valuation sensitive. So once we found the good businesses, we ensure we don't overpay and preferably pay as little as possible, the lowest possible valuation we can. And then the final step is to construct these within a portfolio where we're conscious of diversification, conscious of risk, such that we can create the best possible outcome over time. And with that in the back of our mind, it becomes a little easier to understand, for example, top holdings. Microsoft sits in our top holdings, known by everyone, no surprise, but why do we hold it? Well, if you have a look in the big tech space, everyone does the mistake of sticking big tech into one homogenous bunch. But in fact, these are fundamentally different businesses selling different products and services to different markets that just happen to be using technology. For example, Tesla sells cars. Cars is a very cyclical industry, high overheads, big risks involved. And even though the EVs, even that space is starting to become crowded, and the Chinese EVs have made sure of that. So we consider Tesla a very risky company in terms of cyclical. Meta and Google, for example, are what their core bread and butter is. They sell advertising, and advertising for those marketing spend, which is cyclical, as more and more of the world is digital. The tailwinds of offline advertising becoming online and dissipate, and then it just becomes a dogfight for who has the best advertising, and it's a race to the bottom. And you're even competing with other guys like TikTok and the like. So all of these are actually quite cyclical businesses. All of them are exposed to certain risk. And then you go right across to the other side of the spectrum where you have Microsoft. I'll take a venture as you're talking to me based on a computer that's probably running Microsoft Office or Microsoft Windows. So am I. Most of the listeners or viewers here are probably running Microsoft products in the background. Microsoft sells software utility across the world. Most businesses use it, most governments use it, most users use it. Try to go through a 24-hour period without touching a single Microsoft product or service. So what Microsoft sells right at their core is utility, which means that they could double their price overnight. And we grumble and moan, and most of us would just carry on paying it, which is a vastly different thing to selling cars and selling advertising. And so Microsoft we view as high quality. It's a utility that then you layer in cloud, you layer in AI, and it's got a really exciting growth vectors on it that we think its valuation remains undemanding. And these things combine to help show how our fundamental investing, focusing quality and valuation, comes through and how we pick and put in these investments into the portfolio.
Awesome. Thank you. Yeah, it was interesting for me to look at it. I mean, there's a nice chunk of cash, a little bit of gold in there. You've spoken about Microsoft. One that I'm also quite keen for you to chat a little bit about, just from what we've seen recently in the market, is your investment there in TSMC. And maybe you
Yes.
could talk a little bit around that, please.
Absolutely. So first of all, as the world becomes more technologically orientated, semiconductors become more sophisticated and the world needs more of them. I don't think anyone will argue that. But why TSMC? So if you work through the supply chain of semiconductors around the world, right at the center are the foundries. And of the foundries, there's only one foundry really worth talking about, and that's TSMC. And then if you take each part of these supply chains in and you analyze their margins, you find that the foundries generate the highest margins. And then if you have a look at their valuations, you find that the foundries have the lowest valuations. And if you have a look at the foundries, you see that most of the chips and certainly the high-end wafers have to go through TSMC. So in other words, you're getting the best margins at the one of the lowest valuations, and in a company that's clearly immensely hard to replicate. Intel has been trying to compete with them for a decade and has
Yeah.
actually basically given up now. So there might be an argument that Keith, that valuation has a Taiwanese risk discount embedded in it, but NVIDIA doesn't produce their own chips. TSMC produces NVIDIA's chips. So if TSMC were exposed to Taiwan risk, why isn't NVIDIA? It's their key supplier. So our view is at least in TSMC, that discount is priced in. In players like Nvidia and the like, it isn't when you look at much, much more aggressive valuations. And therefore, we think TSMC operates in an absolutely vital space. It's got superior margins, low valuation, and it really has no competition in how it operates.
Keith, would it be fair to say, I mean, based on what you're saying, this fund and people considering investing in it, it's not a quick in and out or even medium term. I mean, it's probably for somebody that's going to be around a longer term horizon, is going to probably realize more value in this investment.
Definitely, definitely. Thanks, Carl. I mean, that's a good way to position it because as quality investors, these are long-term portfolios. We want to build diversified, good quality portfolios, and we'd like clients to view them as one, long-term investments, and two, because we are conscious about risk and diversification and we hold good companies, not bad ones, this can be a core holding. You can go and take risk around the edges yourself, but you can build this as a center of a portfolio, center of allocation, especially for the long term. And these things will work best when an investor approaches them that way.
Cool. So taking a little bit of a step back from this particular fund, and even your company, maybe just talk a little bit about how asset managers work. I mean, you've spoken, about the fundamentals, but do you guys lock yourself in a room and read articles and trawl the internet? Are you, geeky, clever, actuarial types? Like, what makes a good asset manager to your mind? And I'm putting
So
you
I
on the
would,
spot here,
yeah,
but it's yeah.
yeah,
What?
you're definitely putting me on the spot. But I would say it's the marrying of three to four different attributes. And the first attribute you've touched on, you need to be research orientated because you need to know one, what's happening in the world, two, what's happening in companies, and there's actually a lot of work doing that. Curiosity and passion has to drive you because that's a lot of heavy lifting you're doing. Um, you're ultimately seeking truth of the world of what's actually happening, not reading headlines, but going to the nitty gritty and the fundamentals. So there's the research aspect. Um, then you have to have a practical aspect. So it's not a conceptual approach. And that's why I try to marry, as we're talking here, marry our investment philosophy with how we're actually executing it. We say that we're quality investors and we're valuation sensitive, but but people can stand up and say anything. Can you actually execute that philosophy? So there's got to be a practical mindset to it. And I hope I've demonstrated that, and we think and we try every day to demonstrate that across the portfolio. Then I'd say there's a third aspect where you've got to manage risk. At, everyone talks about returns because that's the exciting part of markets, but it's an infinite game. What I mean by that is you want to keep playing it, but if your capital ever goes to zero, you lose your ticket at the seat. Well, and therefore managing risk ensures longevity. Longevity ensures compounding, and compounding ultimately is the most powerful thing in the world. And not enough people focus on risk. And perhaps the final thing is you actually need to, despite all the research and all the perhaps more nerdy, geeky aspects of it, you actually need to be able to sit here and explain to human beings how you're managing their money. You've got to be a team player within your investment team. You may have diverging views, but you've got to be able to discuss them, disagree, and dig into those disagreements, sit in front of clients and explain the complexity and nuances of the world in a way they can understand, communicate all these things both internally and externally. If you get those aspects working, I think you'll have a good asset manager.
Thanks, Keith. I thought you answered that brilliantly, and it talks to the fact that Keith had a beautiful presentation, which I think he was heartbroken that I said he's not allowed to share. It will be on our blog in support of this webinar and the fund. But to my mind, any asset manager who's half articulate can talk through a fund fact sheet, and they all pretty much at the end of the day just say the fund is amazing and phenomenal, and that's that. It's far harder to talk to what I'm passionate about at EasyEquities, over 1 million really smart retail investors, and articulate it in a way that is not dumbed down, is not patronizing, that helps them really grow and protect their wealth. And I think you've answered that really well, Keith. So thank you. And for those of you who want to follow Keith, he's on X, just at Keith McLachlan, and you'll see the details on our EasyEquity social media. Maybe, Keith, tell us a little bit. Are you still into small caps, or have you abandoned the world of small caps? My
No,
colleague is small cap. I can't swear, but he lives and breathes small caps. So do you think there's still money to be made in small caps?
absolutely, there always is. And across some of our portfolios, we have dotted small caps, but obviously, once you're managing assets at size, one has to be conscious of, and one of the risks is liquidity. So we very selectively have small amounts across portfolios. You won't see them in our top 10 because the funds are too big to have those allocations. But absolutely, there is certainly value in the small cap space. And if nothing else, understanding those companies and meeting with those management teams gives you insight into the economy you wouldn't get elsewhere. So it always helps you managing large cap money as well. But what I like to say is that everything in the market is relative because capital has to sit somewhere.
No. Thanks. Yeah, and I think, I mean, obviously I'm biased with these equities, but for me, it's exciting on the platform that you can, take a bit of your investment cash and look at small caps, some of the larger opportunities. A lot of our retail investors were really excited about the Boxer IPO, but also then, look at some of the managed products, the unit trusts, and specifically one we're talking about now, where users then don't have to worry about it because the asset management team are doing all the worrying for them. So it's a really easy way to have a bit of the DIY and a bit of the managed. So back to this particular fund, Keith, maybe you want to talk a little bit about some of the traditionally boring aspects, but you've made the point that compounding is so important. And part of what makes that exciting is the lower the fees, the better the cost structure of a fund, the more goes into your investment. I mean, is this a particularly expensive fund? Maybe talk around the cost a little bit, please.
Sure. So the unit class, because remember, unit trusts have different unit classes. The unit class that we've listed on the Easy Equities platform is the C class. It's the bulk unit class. Another way of saying that is it's much cheaper than, for example, the direct retail unit class. This unit class has a total service fee of 1% that we think is deeply defendable, given the amount of work that goes into this. And don't forget the Sharia side, there's the investing aspect, but the Sharia side is also work. And,
Mm.
we are constantly being audited in terms of this to ensure the compliance. So I think it's a defendable total expense ratio. I think it's a defendable fee. The nature of the beast is it is an actively managed product, and therefore it'll probably have a slightly higher fee than, for example, a passive product. But you get the benefit of hopefully us picking the correct stocks.
Yeah. And what are you targeting in terms of performance, if you want to give an idea to users? And do you have
So
some target, and how do you look at that?
So that's always a difficult question to answer. So what I like to break it down is in asset class performance, and then whatever that is, we hope to beat that. So the rand versus the dollar depreciates by somewhere between 5 to 7% per year across long periods of time. Add that in with global assets that we hold in this fund, because remember, we are holding these assets offshore, and therefore they're predominantly hard currency assets. If you have a look at like the S&P 500, that tends to grind out somewhere in 8 to 10% return. The last couple of years has been extraordinary, but over the long periods of time, somewhere between 8 to 10% total return per year. Add in the rand depreciation of 5%, you're sitting in the teens. We hope to, at worst, match that, at best, beat that. But remember, within the constraints of being ethical Sharia investor, which is much, much harsher guardrails than, for example, just buying a Satrix 500 ETF.
Mm. And the long-term view as well that people need to be
Yeah,
aware of.
certainly.
I mean, obviously, investors can invest in a range of products on the EasyEquities platform. Unit Trust, perhaps one of the newer ones. Obviously, active managed ETFs have recently been added as well, and that's an exciting asset class for many of our users we're seeing. Unit Trust on the platform is still relatively small. We've got about 1.3 billion invested in that, and we've got a universe of, maybe 100 odd unit trusts. And as you know, it's a massive universe. Trillions of rands invested in,
Mm,
thousands of unit trusts. So we don't want to swamp users with choice. We really are selective about the unit trust that we add on the platform. Now, I mention that because Keith has been extremely pushy and getting more than just this one fund on. And I think you can see why, because of his passion for this fund, but the others that you guys are managing. And Keith, I think the best way to get more funds on the platform from your team is to do more of these information sessions with the EasyEquities users and talk about what you guys are doing. So we look forward to some regular updates. And I'm going to conclude by putting you on the spot again and abusing your brain on a little bit of unit trust course 1, 2, 3. Because education is always appreciated by us at EasyEquities. So you spoke about different classes of unit trusts. Now, that's something that you know about in your sleep, and my colleagues in Easy Asset Management think everybody knows and understands. Most of us don't. Maybe take a little bit of time just talking to us about those different classes and why it's relevant to retail investors. Why the hell should I care about the different classes?
Sure, and excellent question, Carl. So first of all, a unit trust, forget the unit part. It's a trust. That's actually the legal entity. And that trust is a pool of assets that, and I add in the unit part, that as an investor puts money in, they get issued units at net asset value at the time they invest. And when they redeem money, they give back the units and they get whatever those units have grown to in terms of capital back out. Now, unit trusts have the ability to issue different unit classes that serve different purposes or reasons. And they typically called A, B, C, D, and so on and so forth. The A class is typically a retail unit class. which means that the common man in the street will invest in it. And because it's a retail unit class, administration is higher because the invested amounts are lower, and therefore it tends to be more expensive because it attracts more administration. Then you go to, for example, the C class, and I'll repeat again, we've listed the Element Islamic Global Equity Funds C class on EasyEquities. So the easy investors are getting really, really preferential pricing here. But this is typically the bulk or institutional class that, because it has fewer investors but larger sums that go in, the fees are lower. And then you, for example, have a B class, and B class is sometimes a intra-unit trust class where one unit trust is invested in another or vice versa, and that may have zero fees, but you ring fence it because you don't allow outside investors. I've also had a unit trust that I managed that the B class was a flat fee class for tax-free savings accounts. None of Element's funds charge performance fees, so all of our funds and all of our unit classes can be used in tax-free savings accounts. So that's not relevant in this case. But simplistically speaking, each of these unit classes will have a different fee attached and therefore be distributed to a different investor for a different reason.
Right. Thank you very much. This particular fund is not Reg 28 compliant. It won't be available in all your EasyEquities wallets. Some of your other products are, so I hope we get some traction on this, that we can provide some Reg 28 compliant products on. And I think just because my very smart colleague, the head of legal at EasyEquity, Sasha Graham, is here. I don't know if she's on because of your smarts, your looks, or because she's a passionate unit trust investor, or to check that I'm not making any mistakes. But just to repeat that none of this is advice. And what we always like to say at EasyEquities is do your research, look at education, and check out the fun fact sheets. You guys can go to wealth.easyequities.coza. And a big thank you to the team at EasyEquities, from Ops and Carel and Tristan and others who manage the behind the scenes and getting these funds on. But check it out. Check out the costs. I know that Keith and his team will be sending updates pretty regularly on the fund. Keith, I'm sure we'll have you back. And as I mentioned, you've been extremely pushy in the best possible way about getting more funds on. So let's make sure that the community get the benefit of those funds. But thank you very much. We wish you luck as you grow this even more, and we appreciate that you have partnered with EasyEquities and that you've taken the time today to share some information with us. So thank you very much.
Thanks, Carl, very much. We really appreciate this opportunity. We're really excited to be involved in this journey with you guys.
Thank you very much, and enjoy the rest of December, EasyEquities community, and lots more coming down your line with exciting product launches and products. Thanks very much, Keith. Cheers.
Thanks very much. Perfect.